Hello, everybody. Welcome to another episode of ITPM Flash. I'm Senior Trading Mentor Raj Malhotra, and today I want to discuss last Friday's jobs report, which was for the month of August, and how I think the market reaction has been pretty surprising. Now, since then, the equity market is only down slightly, a little over 1%, but the VIX is up well over 10% since last Thursday's close. And the 10-year yield is up from 4.1% to close to around 4.3% as I'm filming this. Now, while all that's surprising, and most importantly, the market is pricing in about a 50% chance of another rate hike in November, while virtually pricing nothing in September. And to me, that is just way too high. Now, I think after I read the jobs report, I think that the chance of a hike should be close to zero. And it should be unless Powell and his cronies are on crack. Now, let's look at specific in that what was on my mind and what were the important points of that jobs report. Now, if you look at wage growth clearly weakened. Now, people will talk about the headline unemployment number, which jumped 0.3%, which was a pretty big move. And more importantly, underemployment number jumped to 0.4%. Now, both of those were pretty big moves, and I'm actually quite surprised the market didn't act a little more negatively to that. However, I guess the market is just assuming. You would think that that's just a little dovish. However, the move in rates does not recommend dovishness. So another key point in that data came out is there's clearly weaker demand for labor. And the most convincing argument for that is this is the 8th consecutive month of negative revisions, implying that the BLS, or should I say the BS models, are overestimating employment growth. So if you look closer, outside of low-paying service jobs, the economy has not added a single job since May. Every other category in that report is flat to down. Most of the jobs added since May are mostly in healthcare and mostly are part-time nurses or those people that sit behind desks. Those jobs are basically $20 an hour jobs. Mostly underemployed or people that are just retired or bored or whatever. But again, these aren't the type of jobs that are going to carry the economy forward. In fact, they're also the ones that are probably more likely to carry the economy backward. And my personal favorite one was the report claimed to have added 6,500 jobs of personal laundry services. Now, I have no idea what the hell those jobs are. But when I looked it up, and it's never been more than 700 of those jobs added. So I don't know, maybe these people are the ones that hired to clean up the mess left by the Bidens. But no matter how you look at the report was very negative for employment, and it has been for a while. Now, that's not all bad per se, because the Fed wanted to slow down the job market, and they probably have. And maybe that's why the equity markets hang in here with a weaker employment picture. Now, but I think the real issue of where the market's getting the long end of the rate curve wrong is oil. Now, the market is thinking probably that with oil near $90 that it's inflationary. And I think it's quite the opposite, which is part of the reason I've been long oil stocks for a while, as you would know if you follow me. Now, the Fed themselves, they only care about oil. They don't care about oil or food prices. They only care about core inflation, which takes oil and food out of their equation. Now, with oil at these levels, it hurts the economy. There's no doubt. And it definitely hurts the services sector. So that's not where I would be picking up long exposure in the services sector right here. It's actually, with oil here, it's actually more deflationary to the core if you think about it. And should oil prices stay around $90, yes, it will certainly help energy companies, but it'll probably hurt the U.S. consumer much more than expected. But on the other hand, the way I'm thinking about it is, let's say oil starts going back down. So what should happen there? So rates should, at that point, should go back down. Either because the market isn't worried about inflation anymore, so hence it's okay with having lower rates, or more likely it's because the economy is weakening and demand is down. So should that happen, the TLT, which is a ETF that tracks long-term rates, the TLT should start going up because there's lower long-term rates. Because the TLT and rates, they move in opposite directions. On the other hand, what happens if oil keeps going higher? Let's say oil starts going towards $100 or higher. The market at that point, maybe not initially, but eventually will realize, well, that's really bad for the consumer. And hence the job market is probably at a standstill. So with bad for the consumer, less jobs, core inflation will probably go lower. And then because of demand, and the TLT will go up and rates go down. So when I'm looking at it, if you go back, the TLT got as high as around 108 this year. Let's say 10-year rates go back to even say 3.5 from where they are now. The TLT should go back to around 105, 106. So should that happen, if you look out on the option curve, you can set up very cheap upside call spreads out to year end, and setting them up with a 4 or 5 to 1 risk reward on these call spreads. As someone who's probably been one of the outliers here and one of the few equity bulls out there, which I've been talking about most of the year while most people were all doom and gloom, I'm not sitting here and calling for a market crash and a big rally on treasuries on the back of that. I'm certainly not saying that. I am, however, saying that this setting these call spreads up in TLT is simply a good risk reward in your book, whether you're long equities or you're calling for a sell-off in the market or whatever. So this, and to me, looking at the structure here, it probably sets up better risk reward than just buying S&P or SPY puts just as a hedge for your portfolio, given the many ways that this trade could pay off. Remember, there are so many reasons why TLT can rally. As I said, it could rally because oil goes back down or oil goes back up. You probably lose if oil just stays right here. Hence, with most options, if you buy and nothing happens, then you will lose money. But also, recession fears start picking back up. If that happens, long-term rates will go down as a flight to safety. If there's more credit events like the regional bank collapses we had earlier this year, that will probably drive rates lower as a flight to safety. Or geopolitical tensions. There's always the issue with more Russia, China, Taiwan, you name it. There's always tension in this world, we know that. So with any of these reasons, this could be a reason for TLT to rally, or ones I have not even mentioned or even thought of. See, the key is for you guys, as good traders, you should always be on the lookout for cheap ways to protect and or profit from the unexpected, even if you don't know why something would or could happen. See, that's the beauty of trading options. This allows you a defined downside loss and a possible asymmetric payoff should your idea hit. Good luck, everyone. Happy trading. I'll see you on the other side.